Ever wondered how spot trading is different from CFD trading? Let's break it down in a simple way. Both happen in the trading world, but they work very differently. Both paths lead to the world of trading, but they take you on very different journeys. In trading, you'll often come across two common options: spot and CFD. Let's peek inside and see how they work. Two styles, two approaches. Whether you're buying real assets or trading price differences. Spot trading is what you see and own. CFD trading is more about what lies beneath: movement, speculation, and strategy. Imagine you're choosing between owning an asset or predicting its price. That's the core difference between spot and CFD. Spot trading means you're buying the actual asset, like Bitcoin, gold, or stocks, and you own it right away. You profit when the asset price rises and sell it for more than you bought it. Spot trading is simple. You own the asset, there's no leverage, and it's great for long-term investors. CFD stands for contract for difference. You're not buying the asset, you're betting on price movement. With CFDs, you can profit whether prices go up or down by going long or short. CFDs allow leverage, which means you can trade with a small deposit. But remember, no actual ownership and higher risk. Here's a quick comparison. Spot for ownership and lower risk, CFD for flexibility and leverage, but with more risk. If you like long-term investing and owning assets, go with spot. If you prefer short-term moves and understand risk, CFDs might suit you. Whatever you choose, know the difference, and always trade wisely.